And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show, the show where we bring you where the action is in the broader markets. A bit of a quiet week this week, certainly holiday shortened, but also we did end on a little bit of a weak note. We're going to get into that, as well as some other underlying dynamics that emerged. First up, we do want to take a look at some of the economic data last week. It was a fairly light period. However, consumer confidence did tumble, and it was cited that Trump's potential tariffs are bringing in that fear to some consumers. So we'll get into some of the other impact from that fear factor there. Also, unemployment claims did slip, so that number came in stronger than anticipated. One of the reasons for today's pullback. Next week, another light period for that economic calendar, but as always, there's enough and a lot going on. Let's go ahead and take a look at the S&P 500 and see where did we close for the week. And here we are, a daily price chart of the S&P 500. You can see that that RSI is now back in negative territory after today's 1% pullback. We also have this MACD heading lower. It is still in positive territory, but not in a healthy way, similar to, for instance, this September-November period. So still shaky. For those of you who have not already, go ahead and take a look at last week's show, where I highlight specifically those signals that would tell you it is safe to get back in, and more than anything, to potentially overweight. We're not quite there yet. Now, I also want to share with you a view of the equal weighted S&P 500. And as noted, it is not going to give those M7 names that big weighting. And you can see this fall off that we had going into this week, but we are seeing a little bit more by way of broadening out. That's what we want to see, because in order for us to have a sustainable rally, we want to have most areas working, and they are not. So let's go ahead from here and take a look beneath the hood at those 11 underlying sectors. And we're looking at a 2-month daily price chart view of the S&P 500 sectors sorted by that relative strength indicator in descending order. So first up here at the forefront, very similar to last week, we do have the growth areas in the front, with XLY being the strongest. That's consumer discretionary. We have technology up here, and then communication services or internet related names. They are all in front of the S&P 500, exhibiting that relative outperformance. But let's go ahead and move through some of these other areas that have been really weak. And this is where we can begin the conversation about potential broadening out. So if we, for instance, take a look here at XLE, it wasn't a fantastic week, but we did see buying on this oversold RSI period here. So buyers are coming in. I'm going to share with you one area of energy that was vibrant last week, and it's part of what's called the Trump trade. Now, taking a look at some of these other down and out areas, you will see similar characteristics with oversold industrials, XLI, potentially turning around. Now, this is where you will want to get your watch list together. For instance, names in the industrial area, such as General Electric, you can see in the throes of potentially reversing its downtrend. It was denied here with that RSI back into negative territory. We have that nice MACD crossover, but I'd like to see it get up above that net neutral zero. But again, we are seeing some movement back into these very oversold areas of the market. Healthcare is another example. Some of those big pharmas were up quite a bit more than the markets, but again, coming out of this RSI below 30 in an oversold period and this V-shaped potential recovery. Now, from here, if you are considering individual groups, ETFs, or individual stocks in that group, you will want to look at the weekly for giving guidance as to the long-term potential turnaround. And for instance, with XLV, this healthcare area, this is another Trump trade, but it's negative because of the announcement of an uncertain cabinet member, RFK Jr. And we can see that this downtrend is not close to being reversing on this longer term weekly chart. We are going to be on the lookout for a move similar to late last year when on the weekly chart, the index moves back above that 200-day simple moving average, get that RSI and MACD up there in positive territory, and that will provide you the confidence for a longer term trade. Now, from here, let's go ahead and take a look beyond these sectors, and I will share with you another what's called candle glance view from Stockcharts. It's a 2-month daily price chart view where I use ETFs to further get your arms around what is shaping up in the markets. And first up here, front and center, not great news in positive territory here is that yield on the 10-year. It is now up here at 4.6%. And historically, that 4.5% has presented the market with issues and volatility. And we certainly do not want to see rates get much higher. It is a negative for the markets, particularly growth and then housing and other interest rate directly related names. So moving along, let's take a look at semiconductors. They fared pretty good, up 3% in an otherwise tough market. We can see SOXX, the ETF, we are not in positive territory here. So we will have more work to do before we can announce that the semiconductor area is positive, but there are some bright spots. You can subscribe to my MEM Edge report where I review that and why with specific stocks. Also moving through, taking a look, I did want to highlight the fact that volatility did jump a little today. We got back up above that 17.5. Anything in that 18 range is telling us that there is evidence of fear and we could see further decline. However, we did pull back. This is the VIX, the volatility index, and we closed at about 16. So we're in okay territory there, but you will want to keep an eye on that volatility because it is going to be one of many signals that can help you with your investment decision making. Now, let's go ahead and move through and take a look at some of these weaker areas. Housing stocks continuing to suffer, down another 1% this week. This is all about that rising interest rate environment because we did get pretty decent housing numbers this past week. And then also negatively impacted by a rising rate environment is going to be biotechs. But here again, we are seeing a little bit of bottom fishing taking place, but nothing that is exciting looking. It is still very much in a downtrend. And then small caps also do not fare well in a period of rising interest rates. And we can see, we did see a little bit of a potential recovery, but it did fall for the week, down 0.2%. IWM is that Russell 2000 index. So from here, let's go ahead and take a look. I mentioned to you one area in energy that is picking up, and I can also share with you why. And one of the names that we can take a look at, it is going to be natural gas, nat gas related. The Wall Street Journal had a very good article for those of you that want to dig deeper. You can look up the ticker symbol EQT, and this is a natural gas company. And what I did want to point out to you is the fact that we are seeing a potential downtrend reversal. We're not quite there yet, but let me share with you what would signal that EQT is getting back into a new confirmed uptrend, and then also share with you why. So what's taking place in the natural gas space is a sense and reality that we no longer have Biden in place and his climate concerns. They are due to recede. We are going to have a new administration in place that is going to be more favorable toward the use of, for instance, natural gas. And for instance, Trump did promise that he's going to fast track infrastructure that could help these gas companies to fuel and get new buyers of natural gas, unlocking a potential new era of growth. So when we are looking at the individual names underlying, we do want to see the stock back above the shorter term 10, 21-day simple moving average. We are getting that RSI up into positive territory. The real factor here that would be make it a lot more enticing would be if we can get that MACD crossover black line up through the red and any kind of decent volume on an advance. So from here, let's take a look at two other names that are also in this industry group and are looking somewhat interesting. First up is WMB, that's Williams, and you can see it too is potentially reversing its downtrend, but not as far along. So if we take a look at this stock, we will want the price to get back up above this 50 and 21-day simple moving average, get that RSI into positive territory, and a nice black line up through the red MACD crossover to signal a new uptrend. Also of note, this stock does offer a 3.5% yield. So that is also a good insight as well. Let's take a look at a small company, PNRG, and this is Prime Energy Resources. Just to show you the vibrancy that is taking shape, this is typical when a group comes into play. You'll see that sometimes those smaller names really have liftoff, and the stock has made that advance back above all these moving averages with bullish MACD, bullish RSI, a little stretched here at this point, but it does appear poised for further upside. Last up, let's take a look at KGS, and you'll see Kodiak Gas Services, another name that had a nice run up November into the latter part of December, pulled back. Here we are with the stock poised to break above these moving averages. We have that positive RSI, and that nice MACD crossover would be making it certainly more confirming. Other names that are possibly turning around that I did want to share with you that you may not be taking a look at these days is Starbucks. Now, SBUX does have the new CEO from Chipotle, but investors and certainly Wall Street are not impressed with what they've seen so far as the possibility of the company getting back to their former glory days. But let's take a look at the chart, because we did get into an oversold position with that RSI down here below 30. And you can see after pulling back to this 200-day simple moving average, we could conceivably see a V-shaped recovery. We are still early in that process, but certainly a name for the watch list that you hopefully are putting together during this period. And then last up, taking a look at using historical precedent as your guide when these stocks pull back. Will they find support? Now, while we're looking at Starbucks, I will share with you one of the key indicators for exiting your stocks. A lot of times we discuss how to enter, but it's more important to have an exit plan. So with SBUX back here with that close below that 50 on that RSI, coupled with a move below these moving averages, and then we had that negative MACD crossover. So let's take a look at a couple of other names here. DOCU, this is a name that I talked about a few weeks back. It came out with fantastic numbers, gapped up, and since then it is in line with what we have seen in software stocks overall. But really taking a look at this pullback and going back historically, you will see that DocuSign tends to pull back to its 21-day simple moving average and then reverse. And here we are. We did have that pullback today to that 21-day simple moving average at 92. So on the lookout for, at some point, a potential reversal. Another name that we can look at, and for me, I do traffic or travel in circles that include very, very fast-moving, high-growth names, AppLovin among them, and we can take a look. This is one of this year's biggest winning names. It had stupendous numbers here on their earnings front back here mid-November, and you can see that we did hit a new high. So we are in a period of consolidation here, this back and fill. So keep an eye out for that black line up through the red to signal a potential new uptrend. And that is it for this week. Everyone, I hope you're having a wonderful holiday period. I'm going to look for you here again next Friday.